that's how you pronounce it, isn't it?
Good,
yeah, good to see you, Cormac. Thanks for joining us. Right, let's deal with this one, because we're going to hear next week from the Vickers Commission. And there has been a sense it's really weighed on bank stock prices. Is it on its own enough not to want to buy UK bank stocks or not?
I don't think so. Particularly today, we got some press, apparently well-sourced press articles over the weekend that basically implied it will be of the light touch variety. I think the consensus expectation was that there might be a hit of maybe $1.25 billion or so for Barclays and RBS, maybe $750 million for Lloyd's PBT. I think after we got those leaks over the weekend, the likelihood is perhaps 50% of that. So if you think in terms of perhaps impact on share price, I would have expected that to have a net positive impact on the banks this morning of maybe 4 to 6%. So I think there are a lot of other negative factors that are weighing on the banks more than offsetting that.
Yeah, well, obviously the big gorilla in the room is obviously Eurozone debt crisis. Now look, we know where we are with sort of, we fear, or we think we know what exposure are to Eurozone banks to this, and we see what's happened to their stock prices. What is the direct relationship between the UK banks and the fears in the Eurozone?
Sure, I mean, first of all, it's incredibly complex because there are direct effects, and then there are indirect effects, and then there are third-order effects. But I think, the direct effects are obviously to the extent that the banks have exposure, so exposure at default in Ireland, Portugal, Greece, Spain and Italy. So, for example, RBS has exposure in Ireland of about 44 billion exposure at default. So the direct effect would be that, in a scenario, say, where Ireland leaves the euro, you could have a 50% default on the new punt, let's call it, which could trigger, a capital deficit, incremental capital deficit for RBS to the tune of 18 to 20 billion, which has a percentage of current market cap of maybe 27 billion. That's a substantial number. That's a direct effect. But then second-order effects are the UK economy would almost certainly slow. And then third-order effect, you would probably see increased push towards austerity from the UK government and other governments. So you see incremental slowing GDP growth. So there are lots of different factors there. And also, worth mentioning as a fourth effect, you would see further stress on funding, and that could potentially increase the pressure on banks to increase capital to try and reduce those funding costs.
Is this all in the price, is the question?
My feeling is that the market is sitting on the fence, as you would expect. If the Eurozone stays stable, I think we can see the UK banks rally very substantially, to the order of 60 to perhaps even 100% from current levels. And the probability of that is perhaps 50-50. Conversely, in the bearish scenario, while on a fundamental basis, if you're able to get the rights issues away at current levels, the downside would actually be quite limited for the UK banks. The reality is that if investors start to realize rights issues are on the way, you start to see technical selling. People just lighten up, raise cash because they know that they're going to be expected to participate in these things further down the road. So in reality, even on a fundamental basis, there's limited downside. In reality, I think you could see maybe 30-40% downside.
Hey Cormac, this is Christine here in Asia. Our earlier guest said, to quote him, it's crazy, it would be crazy to invest in Chinese banks right now. In your opinion, what about those companies like the HSBC, the Standard Chartered, who have big exposure into the greater China markets? Are they risky too?
Sure, it's very interesting. I mean, I've done a little bit of work on China recently. And, if you look at various metrics like fixed capital investment as a percentage of GDP, it's running at, 60 to 70% on some metrics. That's clearly unsustainable. But in my mind, that's, a 3 to 4 year away problem. In the near term, it's very likely that, they can continue to maintain momentum in GDP. Property prices are likely to remain relatively stable in the short term. So I think Chinese banks and Chinese property probably remains relatively stable in the near term, which is clearly a positive for HSBC. However, I do prefer Standard Chartered. Standard Chartered has less exposure to China, operates in Asia economies where macro metrics actually are quite favorable. Has excellent funding, good dividend yield, dividend likely to grow at perhaps 10% per annum. Current PE trades on about 10.5 times next 12-month earnings. Normalized for loan losses, that's 12.5 versus a long-term average of 14.5. So I think Standard Chartered actually looks very interesting at current levels.
All right, we'll leave it there. Cormac, thank you very much for your views. Cormac Leech, Senior Research Analyst in Financials for Canaccord Genuity. Let's get a final word from our guest host, Anantha Nageswaran. Anantha, we have the BOK meeting, RBA meeting as well. We'll talk about risk of inflation. Are we in a scenario where